Congratulations. You've accumulated a $2, $3, $4, maybe even a $5 million retirement account. But what actually happens to that when you pass it to your kids? In many cases, you've just passed along a big tax problem. Welcome to the Wealth and Transition Report. I'm Mike DePaul, a private wealth advisor with Newport Wealth Advisors here in Newport Beach, California. Here's what we often see. Over the course of a long career, it's not uncommon for one of our clients to build a significant retirement account. And naturally, the assumption is this will pass to our kids and provide a meaningful financial benefit. But under current rules, most non-spouse beneficiaries, your kids, are required to distribute those accounts within a 10-year window, which means what took decades for you to build now has to be withdrawn over a relatively short period of time. And those distributions, as we know, are fully taxable as ordinary income. So those withdrawals don't happen in a vacuum. They get layered on top of the income your kids are already earning. And in many cases, that timing lines up perfectly with your kids' peak earning years. So let me give you a simple example of how this plays itself out. Let's say your kids are in their late 40s, early 50s, doing well, earning around $150,000 a year. Now they inherit a $3 million IRA. Under current rules, that account generally needs to be distributed or withdrawn over a 10-year period. So very simply, you're looking at roughly $300,000 per year coming out of that IRA. And that income doesn't replace what your kids are already earning, it just stacks on top of it. So now instead of reporting $150,000 of income, they're suddenly showing $400,000 or $450,000 in a given year. And what we often see in situations like that is a significant jump in tax exposure. At that level of income, they're likely in the roughly 32 to 35% federal bracket, plus California state taxes on top of that, which we know are high. So all in, you could be easily looking at something close to a 40% combined tax rate, which means over that 10-year period, that $3 million IRA could easily result in north of $1 million going to taxes. And that's usually not how people think about it when they're planning. Because on paper, it looks like a $3 million inheritance. But in practice, the outcome can be very different. We can leave much less. We'll even hear things from the kids like, wow, of course I'm very grateful, but I was not expecting this kind of tax hit. And that's really the issue. It's not the asset itself that's bad. It's that without planning, the way it gets distributed can be highly inefficient. Because from a tax standpoint, an IRA isn't the same as other assets. It hasn't been taxed yet. So what's being passed down isn't just wealth, it's a future tax obligation, and often a big one. And when that obligation gets compressed into a shorter time frame, it can create real planning challenges. Now, there are strategies that can help improve this outcome. Things like thoughtful distribution planning during retirement, Roth conversion strategies, and coordination with your broader estate plan. But what we often see is that these decisions aren't always made with that next generation in mind. They're made in isolation. And that's where problems start to show up later. If you have a large retirement account, it's worth thinking not just about how it supports your retirement, but how it ultimately impacts your kids when you leave it to them. Because the goal isn't just to leave behind assets, it's to leave them in a way that's actually efficient and aligned with the bigger picture and in your kids' best interest. And in higher level planning situations, the objective isn't to add complexity. In fact, it's the opposite. It's to simplify through clarity and alignment. This has been the Wealth and Transition Report. I'm Mike DePaul. Hope to see you again soon.